Financial ratios. So today we are dealing with the basic and most vital concept in fundamental analysis, that is financial ratios. So let us not spare much time on the introduction. So let's dive deep into the world of financial ratios. What is financial ratios? Financial indicates the financial performance of the respective company. We'll get to know the financial performance of the company by analyzing financial statements. This financial statement consists of balance sheet, income statement, and cash flow statements. So, financial ratios are those ratios which is taken from the financial statements of the respective company. These financial statements include balance sheet, income statement, and cash flow statements. These financials are converted into ratios or percentages to evaluate the company and its efficiency. So let's know what are those types of financial ratios. There are 5 major types of financial ratios, which includes liquidity ratio, leverage ratio, efficiency ratio, profitability ratio, and finally market value ratio. So let us study one by one in a deeper manner. So what does liquidity ratio actually mean? By hearing liquidity, we get an imagination picture, something like this, right? Yes. Liquidity ratio is the ability to pay current liabilities. So it's the ability to meet current liabilities. This is divided into 4 different ratios, that is current ratio, asset ratio, absolute liquid ratio, and finally operating cash flow ratio. Before going to each of the ratios, let me explain the basic rule. Basic rules. Short-term liabilities. Short-term liabilities are those liabilities which are to be paid within 1 year of time period. These short-term liabilities can be diverted into short-term assets. So this will be absolutely correct. Short-term liabilities diverting for long-term assets will go for toss. It's absolutely wrong. Short-term liabilities are to be paid within 1 year. So if we invest those money to the long-term assets, then cash cannot be converted easily in the long-term assets. So there will be delay in paying back for the short-term liabilities. I mean for the creditors who has given money for the company. So here the company faces a risk of managing their working capital, managing how to pay back the cash for the creditors. Hence, always this rule will be very much important for each and every financial people. Short-term liabilities are used for short-term assets only. Short-term liabilities shouldn't be diverted for long-term assets. The next basic rule will be on long-term liabilities and equities. Long-term liabilities are those funds which are borrowed from outsiders. Equity funds are owners' fund. So this long-term liabilities and equities can be diverted for short-term assets as well as for the long-term assets. Diverting this long-term liabilities and equities for the short-term assets will be correct, and diverting for the long-term assets will also correct, because the payback period for the creditors timing will be a long period. Hence, we can divert those funds for both short-term assets as well as long-term assets.